In Chapter 2, we looked at how the firm performed in the past. But in Chapter 3, we're going to take a look at how the firm might perform in the future. To do that, we're going to use a technique called cost, volume, profit analysis. And the first thing that we need to do in this section in order to do cost, volume, profit analysis is to learn how to find break-even. That is a handy concept that tells us how hard the firm has to work in order to just cover its costs. No profit, no loss. Now understand, the firm doesn't actually want to operate at break-even. It wants to be profitable. However, it needs to know where break-even is so that it can determine how far above break-even it actually is. So the first thing we need to do is take a look at some cost, volume, profit equations. When you were in junior high school or high school, your algebra teacher told you that someday algebra might be useful in your real life. This is the day, so we're going to do some algebra. And the goal here is to use algebraic equations to try to come to an understanding of the relationship between how busy we are and how profitable we are. Now, we already know that on the income statement, total revenues minus total costs equals operating profit. So we could say TR, total revenue, minus TC, total cost, gives us our profit. So, algebraically, we could say our profit is equal to our total revenues minus our total costs. So far, so good. Now, our total costs have two components. We saw this at the end of Chapter 2. Some of our costs are variable and some of our costs are fixed, and they don't behave the same way. So we can take our total cost and we can split it up into a variable component and a fixed component. Now, the variable component is proportional to the number of units that we make. So we can say that the variable cost is equal to the variable cost per unit times X, the number of units. Now we can substitute that back into our equation, and we can say that total cost is equal to the variable cost per unit times the number of units, X, plus our fixed cost. So far, so good. Now, our original equation was profit equals total revenue minus total cost. We can reformulate our total revenue as the price per unit times X, the number of units. That's got to equal total revenue. And we can reformulate total cost, as we did on the previous slide, as the variable cost times the number of units plus the fixed cost. Now we can take this equation and simplify it a little bit by distributing subtraction over the right-hand side of the equation, because we know that subtraction is distributive. We can say that our price per unit times X, the number of units, minus the variable cost per unit times X, the number of units, minus the fixed cost equals our profit. Then we can cluster price and variable costs. We can say that price minus variable cost, whatever that difference is, times X, the number of units, minus our fixed cost equals our profit. Basically, this equation is an income statement in algebraic form. Price minus variable cost times all the units minus the fixed cost equals profit. Now, this term, price minus variable cost, is our contribution margin per unit. In other words, whatever price we sell our units for minus whatever variable cost that unit incurs equals the contribution margin for that unit. If we multiply that contribution margin per unit times X, the number of units, we get our total contribution margin. So if we take our total contribution margin, subtract out our fixed cost, that should give us our profit. That's a very handy equation for cost, volume, profit analysis. That's the equation that we're going to use to try to understand how changes in our level of activity or changes in our price structure affect our firm's ability to be profitable. So let's look at an example. Here's an income statement in contribution margin format for Dave's Donuts. If you take a look at the income statement, you can see that he sold 12,000 units at 60 cents a unit, that he had 30 cents of variable manufacturing costs and 6 cents of variable selling and administrative costs, and $15,000 of fixed costs. And he ended up with an operating profit of $1,380. Now, his contribution margin per unit we can figure out in a couple of ways. One way is to take his total contribution margin, $2,880, and divide by the total number of units. And that tells us each unit contributes 24 cents after we have considered all of its variable costs. Alternatively, if we wanted to, we could take the 60-cent selling price and subtract out the 36 cents of variable cost, and we would end up in exactly the same place, 24 cents of contribution margin for each donut that Dave sells. Well, let's take a look at a different example. Last month, ABC Company made 2,000 units, and we're given a bunch of information about operations during the period: sales revenue, material and labor costs, variable overhead, and then depreciation and rent, which we would probably assume are fixed costs. So the question is, how much is ABC's contribution margin per unit? Well, the formula for contribution margin is sales minus our materials and our labor and the variable portion of our overhead. In this particular case, our sales revenue is $48,000. We can subtract out our materials, our labor, and the variable portion of our overhead, and that tells us that our total contribution margin is $11,000. But this question asks, how much is the contribution margin per unit? That means we have to divide by 2,000 units, and that tells us that each unit contributes $5.50 to the firm after it has covered its own variable cost. Now, what happens to that $5.50? Well, initially, each unit that's sold contributes its contribution margin to covering fixed cost. But once fixed costs are covered, each additional unit sold contributes its $5.50 to firm profitability. So let's use that idea to find break even, that point where we have sold just enough units to cover all of our fixed costs and not enough units to have any profit. The formula for break even in units, we have to go back to our original formula. Profit equals the contribution margin per unit times X, the number of units that we sold, minus all of our fixed costs. So we can solve for X because we know that our profit is going to be 0 at break even. No profit, no loss. Solving for X, we can say fixed cost equals contribution margin times the number of units that we sold, or X, the number of units that we sold, equals fixed cost divided by the contribution margin per unit. In other words, whatever contribution margin each unit gives us, we need to sell enough units to cover our fixed cost. Let's look at this for Dave's Donuts. Going back to that problem, we know that our fixed cost was $1,500 that was given, and we figured out that the contribution margin per unit was 24 cents. When we divide that out, it tells us that Dave has to sell 6,250 units just to break even. Why does that work? Each unit that he sells contributes 24 cents toward covering his fixed cost. If you multiply 24 cents per unit times 6,250 units, you get $1,500, exactly his fixed cost. If he sold one less donut, he'd be operating at a loss. He wouldn't have enough contribution margin to cover all of his fixed costs. And if he sells one donut more, now he'll have 24 cents of profit. So, if Dave sells this number of donuts and they really have a contribution margin of 24 cents, he'll just cover his fixed costs. Another useful number is what's called contribution margin ratio. This is a number that most students don't seem to like, but it's actually very useful depending on the way that data is presented to you. The formula for the contribution margin is the actual contribution margin divided by the actual sales. So what that's telling us is how many pennies of contribution margin the firm gets per dollar of sales revenue. And those pennies, that portion of each dollar of sales, is now available either to cover the fixed cost or to contribute to firm profitability. So let's see how that works for Dave's Donuts. The formula for contribution margin ratio is total contribution margin divided by total sales. Or on a per unit basis, we could say it is the contribution margin per unit divided by the sales revenue per unit. The proportion has to be the same. In this case, we know that Dave's contribution margin is 24 cents and his sales revenue is 60 cents. So that tells us that he has a 40% contribution margin ratio. Now, what does that actually mean? It means that 40% of each sales dollar is available either to cover fixed costs or for firm profitability. To put it more simply, that's 40 cents out of each sales dollar. So where did the other 60 cents out of each sales dollar go? It went to cover the variable costs. If you'd prefer to do contribution margin in total, or if the data makes doing it in total more convenient, you can use the same formula, but in this case you would use total contribution margin divided by total sales. You get your exact same 40%, and it tells exactly the same story. 40 cents out of each sales dollar is available for covering fixed cost or covering profit. Now let's see if we can find break even not in units but in dollars of sales revenue. Marketing people tend to like this understanding of break even better because they think of break even in terms of dollars of sales. So the formula, the easiest formula for break even in dollars is to take the fixed cost and divide by the contribution margin ratio. Let's take a look at how that works for Dave's Donuts. We know that the firm's fixed cost is $1,500. Contribution margin ratio was 40%. When we divide it out, we get a number, $37.50. Remember, that's dollars of sales revenue, not donuts that need to be sold. Another way to find the answer to this question is to use our original computation of break even, how many units we had to sell, and multiply by the selling price. In this particular case, Dave's break even was 6,250 units, and the units sold for 60 cents each. If we multiply that out, that gives us the same answer, $37.50. And what that number is telling us is that if we sell enough units to generate $3,750 worth of sales revenue, that will be just enough to cover all of the variable costs for each unit and give us $1,500 left over that we can use to cover our fixed costs. Most accountants don't like graphs. However, they're incredibly useful. This is a cost volume profit graph for Dave's Donuts, exactly what we've talked about so far. If you take a look at the graph, this line represents our total sales revenue. That is, if we sell no units, we get no sales revenue. For each unit that we sell, we get 60 cents of revenue. So at 2,000 units or 4,000 units or 6,000 units, we can go across and see how much sales revenue that would be at 60 cents each. Thus, the slope of the revenue line is 60 cents per unit, the selling price of a donut. This dashed line is our total cost line. Remember that our total cost is comprised of a fixed component and a variable component. The fixed component was $1,500, and then we had a total of 36 cents per unit above that amount for each donut that we made and sold. So the slope of this line is 36 cents per unit. Where the two lines cross, that represents break even. That's the point where the total revenue is exactly equal to the total cost and there is no profit, no loss. If you project down to the x-axis, you can see that that occurs at 6,250 units. And if you project across, you can see that break-even occurs at $3,750 of sales revenue. That's the place where we sell just enough units to cover all of our costs. Now, below break-even is our area where we would be operating at a loss. In other words, if we don't generate enough sales to break even, we can't cover all of our fixed cost. And the farther away we are from break even, the bigger the loss is. On the other hand, above break even is our area of profitability. And the farther away we are from break even, the more profit we generate because our fixed costs are fixed. Once we cover them, we get to keep 24 cents of contribution margin for every additional donut sold. So our profit gets bigger and bigger the more units we sell above break even. In order for this graph to be useful, however, we must be able to make a couple of assumptions. Number one, we have to be able to assume that our selling price and our variable cost per unit don't change with the number of units that are sold. In other words, there's no volume discount. If there were, then these wouldn't be straight lines and our math would be much more difficult. The other thing that we need to be able to assume is that we are able to classify all costs as either fixed or variable. Again, this is to help simplify our math. This type of analysis is useful for predicting the future, in part because it's very simple, and we use these simplifying assumptions not so that we can get a very exact idea of what the future will be, but so we can get a reasonable idea of what the future might be. So let's do a practice problem. This firm, XYZ, sells a product for $2 each. They have 80 cents of variable cost per unit and fixed costs of $12,000. So my first question to you is, what is XYZ's break-even in units and in sales revenue? Well, to find break-even in units, we need to know the contribution margin. The formula is price minus variable cost. For XYZ, their sales price is $2. Their variable cost is 80 cents. That gives them $1.20 of contribution margin per unit. Now we can take our fixed cost and divide by the contribution margin per unit. That's $12,000 of fixed cost divided by the $1.20 contribution margin. That gives us 10,000 units. If we sell 10,000 units, each unit will contribute $1.20 of contribution margin. We'll have just enough to cover our $12,000 of fixed costs. Now, what if we want break-even in sales revenue? In that case, we have a couple of ways that we can approach the problem. One way is to take the 10,000 units and multiply it by the $2 per unit selling price. That means that if we generate $20,000 of sales revenue, we will have sold 10,000 units. We'll have just enough sales revenue to cover the variable cost of each of those units and cover our fixed cost. Another way to solve this problem would be to use contribution margin ratio. The formula is contribution margin divided by sales. For this product, that's $1.20 contribution margin divided by $2 selling price. That gives us a contribution margin ratio of 60%. In other words, 60 cents out of each sales dollar is available to cover fixed cost or contribute to firm profitability. So now we can take our fixed cost and divide it by the contribution margin ratio, and that will give us our answer in sales revenue. $12,000 divided by a 60% contribution margin ratio means we need to sell $20,000 worth of units in order to cover each unit's variable cost and be able to cover our $12,000 fixed cost as well. These two methods will always give us the same answer. Sometimes, depending on the way that the data is presented, one method might be easier to use than another.